Welcome to our CFP Exam Prep podcast. Today we're diving deep into retirement distribution rules, specifically focusing on qualified plans. Understanding these rules is crucial as they frequently appear on the CFP exam and are often the source of tricky questions. Let's start with the fundamental concept of qualified plan distributions. Qualified plans like 401ks and traditional IRAs are subject to two main distribution requirements. First, there's the age 59.5 rule, which marks the earliest you can withdraw without penalties. Second, there's the required minimum distribution age, which is now 73 for those born between 1951 and 1959, and 75 for those born in 1960 or later. The early withdrawal penalty is a critical exam topic. The IRS imposes a 10% penalty on distributions taken before age 59.5. However, many candidates miss the exceptions to this rule. These exceptions include disability, death, medical expenses exceeding 7.5% of AGI, and qualified higher education expenses. The exam often tests these exceptions through scenario-based questions. A common mistake students make is confusing substantially equal periodic payments, or SEP, with required minimum distributions. SEP is an exception to the early withdrawal penalty, allowing distributions before 59.5 without penalty if taken as a series of substantially equal payments over your life expectancy. This must continue for 5 years or until age 59.5, whichever is longer. The exam might present a scenario where a 55-year-old wants to access their IRA. Recognizing CP as a viable solution is crucial. Required minimum distributions, or RMDs, represent another significant testing area. A frequent error is miscalculating the first RMD date. While RMDs must begin by April 1st of the year following the year you turn 73, taking that first distribution in the following year means you'll need to take 2 distributions in that same year. This could significantly impact tax planning. Here's a practical example that often appears on the exam. Consider a client who turns 73 in June 2024. They have until April 1st, 2025, to take their first RMD. However, they'll also need to take their second RMD by December 31st, 2025. The exam might ask about the tax implications of taking both distributions in the same year versus spreading them across 2 tax years. The qualified charitable distribution rule is another commonly tested concept. Individuals aged 70.5 or older can make direct transfers up to $100,000 annually from their IRA to qualified charities. These distributions count toward RMDs but aren't included in taxable income. Many test takers forget that QCDs must be direct transfers. If the money first goes to the account owner who then donates it, the tax benefit is lost. Remember that different rules apply to inherited IRAs. For non-spouse beneficiaries inheriting after 2019, the 10-year rule generally applies, requiring complete distribution within 10 years of the original owner's death. The exam often tests exceptions to this rule, such as for eligible designated beneficiaries. Let's wrap up with a key testing strategy. When you see distribution questions, always check the client's age first, then look for any exception conditions. Consider whether the situation involves early withdrawals, RMDs, or inherited accounts. These details will guide you to the correct answer. These distribution rules significantly impact retirement planning strategies, and understanding their nuances is essential for both the CFP exam and real-world application. Remember to focus on the exceptions and timing requirements, as these are the areas where the exam frequently tries to trip up candidates.